Let's discuss an important question today. Should you be using the same investment strategy if you have 1,000, 10,000, 100,000 or even €1,000,000 to invest? And is it better to add more ETFs or other asset classes as your portfolio grows in size? I am hoping to provide you with some ideas in this video, all of which are of course based on my own experience as an investor since 2017 and my personal risk tolerance. In the end, you'll still need to decide what's right for you and what you're comfortable with. One important thing I have to mention at the start: if your time horizon is 5 years or less, for example because you're planning to buy real estate with your savings soon, then the strategies I'm talking about today are not for you. If you fall into that category, you can't risk your portfolio dropping in value at the wrong time due to a correction or crash, which is a normal part of investing and nothing to be afraid of, but can take years to recover from. Instead, you should aim to minimize risk as much as possible and stick to high-yield savings accounts, for example the 4% interest offered by Trade Republic with a €100,000 bank deposit guarantee, short-term euro government bonds with good ratings, or money market funds. You can find some of the best options in a video linked down below. You're still here? Alright, then let's start with the smallest portfolio today, 1,000 to 10,000 euros. At this stage, I would just pick a single, global, low-cost ETF you're willing to hold over the long run, and that's it. This comes with the added benefit that you'll start building valuable investment experience right away, as you'll learn what it feels like when the market goes up or down. Just get started with investing and don't go into analysis paralysis or overcomplicate your portfolio with a large number of single stocks, ETFs or other asset classes, which would likely be a waste of time anyway due to the small amount of money we're talking about. That's because in the grand scheme of things, whatever you're investing right now is likely only a small percentage of the total amount you'll be able to invest throughout your working career and lifetime. So don't waste valuable time obsessing over the right time to invest. I can honestly tell you from first-hand experience that it never feels like the perfect time. There is and always will be something to worry about. Don't let that stop you. If you want to include stocks from both developed and emerging markets, you could pick the Vanguard FTSE All-World, which is the one ETF my wife and I buy on a regular basis, the SPDR MSCI All Country World Index Investable Market Index for a bit more small cap exposure, or the iShares MSCI All Country World ETF. Meanwhile, if you feel more comfortable investing only in developed markets, I think the SPDR MSCI World or the Vanguard FTSE Developed World are some of the best options, with the second one including 2 more countries, South Korea and Poland, and diversifying over a larger number of stocks, including some smaller companies. Anyway, once you've selected an ETF to get started with, your focus should now be on finding ways to raise your income in order to increase the amount you're able to set aside and invest on a monthly basis. Reviewing and cutting unnecessary expenses that you get little value from could also be a good idea to raise your savings rate further. As usual, you can find what I believe to be the best low-cost brokers for ETFs in Europe linked down below in the description, which is a great way to support me if you'd like to. And while you're there, don't forget to subscribe to the channel so you don't miss out on upcoming videos. Let's look at a 10,000 to 100,000 euro portfolio next. As you now have more funds to work with, most YouTube videos and articles will tell you to add more ETFs, individual stocks you're interested in, and other asset classes. You can of course do that, and we'll get to some options in a second, but I would still challenge that way of thinking. After all, with a single ETF like the Vanguard FTSE All-World, you're already investing into over 3,600 stocks from all over the world, and stocks have proven themselves to be one of the best ways to build wealth over long time periods. As long as you're willing to keep holding your ETFs through corrections or crashes, which are a normal part of the journey, or even better to keep investing, getting more shares at a discount, I think it will be very hard to beat low-cost ETF returns long term. Even more so when you factor in trading fees, taxes you owe when selling individual stocks at a profit, and what your time is worth. When we additionally consider the fact that even the vast majority of professional fund managers underperform passively indexing into an index via ETFs, I'd argue that making your portfolio more complex is unlikely to increase returns over decades. Having said that, you can of course add other ETFs or alternative asset classes if you so choose, to either decrease your portfolio's volatility or in the hopes of generating higher returns by taking on more risk. For example, you could aim for a core satellite strategy where the vast majority, 70 to 90%, is invested into the core, the investment you have the highest conviction in long term, like a low-cost, well-diversified ETF, or even several ETFs if you want to control how much is invested in each region. You could then split the remaining 10 to 30% between a few satellites, basically other investments you're interested in pursuing. Here are some ideas for satellite investments. You could add an MSCI World Small Cap ETF to cover thousands of smaller stocks as well, a Stocks Europe 600 ETF to increase your exposure to European stocks, with 1/3 of the index being smaller stocks. Get more exposure to real estate via an ETF covering REITs and real estate companies. You could add a handful of single stocks you're particularly interested in, a small allocation to peer-to-peer lending which has a low correlation to stocks. Or if you want to get a lot more speculative, you could add a tiny bit of crypto like Bitcoin and Ethereum. Just be aware of the high amount of risk you're taking. Again, these are just some ideas. In the end, it's obviously up to you how far you want to take this. Keep in mind that rationally speaking, you don't have to make your portfolio more complex just because it's growing in size. Okay, now we're getting into the 6 to 7 digit territory, 100,000 to a million euros. This is where my wife and I currently stand as well, with a shared investment portfolio of 377,000 euros, the large majority of which, over 279,000 euros, are invested in passive low-cost ETFs. What I said before still applies here as well. Don't let anyone tell you you have to make your portfolio more complicated just because you're dealing with larger amounts of money. You could keep it just as simple as when you started. My wife and I are just buying a single ETF to cover the stock market, for example, as we appreciate the simplicity and we know we're unlikely to be able to predict which sector or which country's stocks are going to perform best in the future. As a result, we just buy the market as a whole via the FTSE All-World. Or you could once again follow a core satellite strategy like we talked about in the previous section, enabling you to diversify further or to take on more risk with a small percentage of your portfolio if you so choose. If one of your smaller bets works out, then great, this might give you a small boost in returns, while if it doesn't, the damage will be limited to its size in your portfolio. I personally wouldn't bet more than 5 to 10% on a single stock or highly speculative assets like crypto, for example. Now, with your net worth beyond 100,000 euros, adding a small piece of physical real estate starts to become an interesting option to diversify as well. Just know that in comparison to any of the other options I mentioned today, it's definitely not a passive investment, rather a small side hustle, especially if you're planning to rent it out. And the decision to buy still needs to make financial sense considering all costs, and it needs to fit into your ideal lifestyle. In our case, we appreciate the freedom of not having to deal with tenants or other sudden unexpected expenses or worries that come with home ownership, which is why we haven't been interested in real estate so far. The same goes for our home residence, thanks to our low housing costs of only 775 euros per month. And yes, I know we are extremely lucky. It would make zero sense for us to buy a similarly sized apartment in Vienna for upwards of 350,000 euros based on current market prices. But your situation may be different. There are of course many other options like startup investing that could be worth looking into with a larger portfolio, but since most startups fail and I have zero experience with this asset class, I'm certainly not the right person to talk about this. Alright, so far I was strictly talking about the portion of your net worth that you're ready to invest and exposed to risk and volatility in order to beat inflation and grow your wealth long term. You should have a time horizon of 5 years at the very least, ideally 10 years or more with any of these strategies, and you should be able to handle your portfolio moving up and down in value on a regular basis. Here are monthly MSCI World ETF returns, just to give you an idea what that looked like over the past 15 years. Now, there's one important thing I should probably have mentioned at the start of the video, your emergency fund. Depending on your own situation and safety nets like unemployment pay in your country, you should have at least 1 to 6 months of living expenses set aside in cash in an emergency fund. This way you're covered and have peace of mind if you were to suddenly lose your job, for example, or if other unexpected expenses come up. This money should be secure, easily accessible, and not invested in risk assets, so don't try to maximize returns here. A great option my wife and I use for our own cash reserves is Trade Republic, which pays 4% interest per year, secured by a 100,000 euro bank deposit guarantee. As we approach the end of the video, I hope you don't come away disappointed that I didn't mention 10 ETFs to spread your money over, or a long list of alternative investments and asset classes that all need to be added as soon as your account grows in size. I could easily have done that, and it may have made for a more exciting video to watch. But honestly, I don't think that is necessary, at least not based on my own investment experience over the past 7 years. I certainly haven't felt the need to add more and more investments and asset classes myself, even as the portfolio share with my wife has grown significantly. Rather the opposite actually, I've learned to appreciate keeping things simple even more. But maybe that's just me. It's perfectly fine if you feel differently. I'm not here to tell you what's right or wrong for yourself. Even billionaire US investor Warren Buffett instructed his trustee to simply invest 90% of his money into a passive stock market index after he's gone. And we're talking about many billions of dollars here while we're wasting time debating the right asset allocation as our portfolio grows to 10 or 100,000 euros. At the end of the day, whichever well-diversified low-cost ETF you pick as your core investment, you'll likely do better than the vast majority of investors as long as you're willing to hold it over a decade or more through ups and downs. It's up to you if you end up making your portfolio more complex by adding a few other investments or even splitting your core investment into a few ETFs, individually covering different regions with allocations you prefer. Just make sure you limit any risky bets, especially those that could go to zero like crypto or a single stock, to a small percentage of your nest egg so that they can never take you out of the game if they were to go wrong. And don't forget to tap yourself on the back and celebrate when you reach any of the financial milestones we talked about today. You'll likely realize that the first 1,000, 10,000 or 100,000 is the hardest, and it gets easier afterwards, in large part thanks to compounding. I've made a video about this as well, including historical ETF data, which I'll link right here. Anyway, I hope you learned something useful that helps you on your own investment journey. It was an interesting thought exercise for me as well, as it allowed me to think through how I would allocate different amounts if I was starting from scratch today. Of course, all of what I talked about today was based on my own risk tolerance. Yours may be different, and you may need to keep more cash on the sidelines to feel more at ease during periods when markets are down, for example. Now, before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. You can find the best low-cost brokers for ETFs in the description below, which is a great way to support me if you'd like to. And please keep in mind that none of what I talked about today was of course meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.